I fear that the Chinese growth model has been broken, said Klaus Baader, global chief economist at Societe Generale. With its decline in population, China's period of rapid growth is likely over. How it's going to cope up is critical for the world. So, let's analyze why China's incredible growth spurt is finally over. According to Klaus Baader, China may be able to avert a real estate crisis, but its economy will only grow tepidly and may never overtake the United States. Fearing the possibilities of liquidation in China, Evergrande Group lowered real estate stocks in this country to fall to the lowest level in 9 months. Recently, the OECD lowered its forecast for the country's gross domestic product, saying output is unlikely to exceed 5% next year. People wonder when the Chinese economy will be bigger than the US economy. And I don't think that will happen, he said. Because of the housing-based industrialization model, you can't do this forever, especially when your population is shrinking. Baader, a Lehman Brothers veteran, said the huge risk of Chinese financial boom, reminiscent of the 2008 US banking failure, is unlikely to materialize because of the country's weak banking system. The worst in terms of economic growth for China is over, but this will be a very moderate growth pattern, not comparable to what came before. Baader said, "I am concerned that China's growth model is broken, and so far, no one has found a new model." When much of the world experiences a major recession in 2008 to 2009, China, through massive public spending efforts, weathered the storm and supported the global economy. With the world dangerously close to a global recession fueled by Russia's war in Ukraine and the 3-year COVID-19 pandemic, a repeat of the China-led recovery seems unlikely. More likely to happen, the country's economic growth is continued to slow in 2023 before rebounding in the second half of the year, according to the Nikkei Stock's Economist survey. The average GDP growth figure given by the group was 4.7%, with the majority of forecasts ranging from 4.0 to 5.9%. However, even the most optimistic recovery scenario for China does not herald the return of breakneck growth rates the country has been accustomed to for decades. China's GDP has risen by an average of nearly 10% per year since Beijing embarked on economic reforms in 1978. The world's second-largest economy has been through a period of turmoil since the pandemic began. After initial optimism about the region's recovery in 2020, ongoing crackdowns on the private sectors and strict non-COVID lockdowns have wreaked havoc. The country's population depleted last year for the first time in 60 years, raising questions about its future workforce. Now that President Xi Jinping has effectively been established as China's leader for life and the country has finally emerged from the COVID-free status, can the country hope to return to sustainable high growth? If you're looking for a short answer, no. Economists say China's era of double-digit growth is almost certainly over. How much growth China can sustain in the coming years largely depends on how Beijing adapts to the structural challenges facing its economy and the impact of its priorities. According to the World Bank data, China's year of strong GDP growth have caused the country's economies to grow more than tenfold from the beginning of the century to 2021, from $1.2 trillion to nearly $18 billion. Trillion US dollars. In contrast, the GDP of the United States, the world's largest economy, is just over double of what it was in 2000. In the coming years, however, China's growth rate will slow to 2 to 5%, estimates Michael Pettis, a senior fellow at the Carnegie Endowment for International Peace. Focusing on GDP figures risks missing the forest behind the trees. Such figures only give an incomplete and delayed pictures of China's economy. According to the data, the period of high growth seems to be ending today, but in reality, in terms of productive investment, it ended about 10 to 15 years ago. Most economists seem convinced that China's previous growth model was on track, but not the current one. The unique economic and demographic conditions that China exploited to achieve unprecedented growth in recent decades have faded. The abundant labor supply that powers China's low-cost industrial base is shrinking as its population rapidly ages. This year, China was replaced by India to become the world's most populous country. Debt-heavy investment in real estate and infrastructure, which once powered China's growth, have also peaked. Hong Tran of the Atlantic Council said these investments offers diminishing returns. China's total factors productivity, a measure of how much output the economy actually produces from a given portion of inputs, is no longer growing as it once did. Before 2008, productivity growth averaged 2.8%, but since then, the growth rate has slowed just 0.7% per year. This has left many companies and local governments over-indebted, as evidenced by the collapse of the country's largest real estate developer, Evergrande, in 2021. The proportion of China's population aged 15 to 64 is gradually decreasing after peaking at just under 1 billion in 2015. Hung said abolishing the hukou system, which linked welfare benefits to household registration, could increase the level of urbanization supporting China's workforce. The current system often leaves migrant workers in cities without access to social benefits, such as public education, which has the effect of discouraging further urbanization. Further automation manufacturing operation by leveraging China's advanced digital infrastructure could also help maintain industrial productivity. Yet, even as Beijing seeks to ease the turmoil that has led to lower growth, the country's political leaders are setting new priorities for China's journey. Mr. Xi has shifted Beijing's policy away from the growth at all costs slogans pursued by previous post-reform leaders. Instead, he emphasized high-quality growth, the guiding principle of China's current 5-year plan, which prioritizes resilience to external pressure and a more equitable distribution of China's wealth. Essentially, the idea to reduce China's dependence on export-led growth by building an economy driven by domestic consumption. Expert says, a strong domestic market can act as a cushion against shock caused by volatile global trading system and Western sanctions. China's new strategy also aims to reduce the country's carbon emissions while pursuing cutting-edge technologies, such as advanced semiconductors and quantum computing. Developing these technologies domestically has become even more important for the country amid a wave of tough export control restriction imposed by the United States to cripple China's chip industry. But can high-quality growth create the same galloping growth rates as before? Theoretically, it could happen, but it has never happened before in history. Pettis said, consumption is key here. The share of household spending in total GDP stood at about 38% at the end of 2021, much lower than global average of 63%, making China one of the countries with low consumption among major global economies. Unless household consumption managed to increase, GDP will be around 2 to 3% at best, he said. China's slowing growth engine will impact everyone, but not in the same way. Many countries, especially those that currently rely on China as their main export destination, will clearly feel the decline in demand. How quickly countries can pivot to faster-growing emerging markets like India and Southeast Asia will largely determine the winners and losers of this transition. The downturn will also affect the geopolitical balance of power. If China reaches its economic peak in the next decade, the dream of overtaking the United States as the world's leading power will seem inevitable. Experts warn that such scenario could prompt Beijing to take bolder action on what it considers its core interests, such as the status of Taiwan, while the country is at the peak of its power. Why do economists also predict unrest in China? Mr. Xi adopted the Mao-era slogan of shared prosperity as his guiding economic principle, turning Beijing's attention to tackling inequality from housing to healthcare and education. Although implications details are scarce, prosperity has also become the rhetoric of muscular intervention in markets. For example, Chinese tech CEOs pledged billions of dollars to cost shortly after crackdown wiped more than $1 trillion in combined market value from their companies. Shared prosperity is not truly redistributed in the sense of the model, said Alicia Garcia Herrero, chief Asia-Pacific economist at Hong Kong-based Bank of America. After all, China has yet to raise its corporate tax rate, which ranged from 15 to 25%. From decades, maintaining high economic growth has been essential to the legitimacy of rooting CPP. In this new era of lower growth, however, the nominally communist government may need new narratives to maintain its legitimacy in the eyes of the Chinese people. There is a need to promote shared prosperity to address growing inequality and distribution of wealth that can lead to social discontent and unrest. If China succeeds, it could achieve slower but hopefully more equitable and sustainable growth, and a new social contract between the parties and the country's 1.4 billion people. So, what are your thoughts on the current Chinese scenario? Is it going to affect the overall power politics? Comment your thoughts, and do subscribe and like for more interesting analysis.